And this is something that's hot off the press too. Secure Act 2.0 signed on really the end of December, I think it's the 29th. There's a lot of components of this. We're currently unpacking all of this, but there's three things that stand out we're going to hit on now. One, RMDs, required minimum distribution, the age that people are required to take money out of those individual retirement accounts. That's being bumped out further in time or further in age, such that in a couple of years, it'll be age 73. And then 10 years from now, it'll be age 75 for required minimum distributions. The other piece related to 529s, this is interesting. Individuals are able to convert unused $529 into a Roth IRA for that beneficiary, right? So what's interesting there is that if there's excess dollars that didn't get consumed for the college tuition expenses, that can, under certain circumstances, be converted to a Roth IRA, which becomes a college savings vehicle, gets converted into a retirement savings vehicle. Participants in an employer sponsor, like a 401k type account, will be able to elect to have 401k matching, not their own contribution, but matches done in a Roth contribution format, Roth match. Historically, that was not the case. There's always a pre-tax contribution. Going forward, there's the option to have a Roth match. So also interesting. We saw really a lot of red negative returns across a lot of broad asset classes. US stocks are down about 19 for the year in total. International did a little better, or a fair amount better, down only 14. Emerging was down about 20, and real estate down about 24%. Commodities were the one shining area. That was largely due to energy markets. We saw commodities were up almost 16% for the year. Those dots is looking at a forecast on where both the Federal Reserve thinks they're going to go on a go forward from a rate hiking or decreasing standpoint, as well as where the market thinks the Fed's going to go. And so the Fed has one indication, their variables, they have a dot plot, they call it, in terms of where they expect interest rates to go. But then the market also prices in daily the expectations. But the point is the Fed's probably going to continue to increase short-term interest rates, followed by at some point, they're going to start decreasing rates. Again, the goal here is to increase rates, try to snuff out inflation, ideally without causing a recession. That would be more of a soft landing. And then at some point, again, cutting rates to kind of, again, spur the economy on the other side of this part of the cycle. Think of the government fiscal policies. This is the, think of this as an income statement for the government. We have revenues and we have expenses. Revenues, whether it's tax receipts, expenses like Social Security, defense spending, veterans programs. And then, of course, we've got interest on debt. Right? Interest on debt is the amount of interest that the government's paying every year to service the debt that's outstanding. The debt has increased lately, but because interest rates have remained relatively low until now, that servicing cost has kind of remained relatively low. It hasn't changed a lot. The projected amount for 2022, it comes in at $399, almost $400 billion to spend on servicing the debt portion, the interest on the debt. Not paying it off, that's just servicing the interest. If we looked at a comparison, so the US Treasury is issuing, they do Treasury auctions periodically every month or so. And as they auction off securities, right, they're typically using that to finance or kind of refinance existing outstanding bonds. So if we went back 2 years ago, let's rewind. 2 years ago, government was able to issue $40 billion of Treasury bonds, a 2-year Treasury bond. So the last 2 years from the time they issue it, at an interest rate of 0.15%. That was the prevailing rate at that time. You can see on the bottom here, that was a very low rate, and it basically was near zero, okay? The cost to finance $40 billion for 1 year at 0.15 is $60 million of interest, okay? The most recent auction, we went back to December. Those are the most recent auction we looked at in the auction results. The financing on a new 2-year bond is 4.3%. Right, so the same $40 billion now is financed at 4.3% yield. That costs $1.7 billion a year to finance that same $40 billion, right? That's a material increase. In fact, it's a 28x or 28-time increase in the cost of borrowing. That was one auction, that was December, on just the 2-year bond. When they issue auctions, they do anything from less than a year, 2 year, 3 year, 5, 10s. Right, there's a whole series of auction securities. This is just one of them. So the reason we're bringing this up is at some point, this is going to be more and more of an issue, meaning the cost to finance all this debt, if we keep rates high for too long, is going to be a bigger and bigger issue. And so we might see then kind of somewhat of an artificial ceiling perhaps to where interest rates are kind of starting to come down because hopefully ideally inflation's come down and we're able to lower rates before too much of the debt gets refinanced at these really high rates and makes this interest cost burden just too high.